Well, folks, it is official. The NASDAQ is down 20.79% year to date. We are officially in a NASDAQ bear market. And the question now is this the bottom? Is this time to buy the dip? Or is this just the beginning? I mean, if we compare now on logarithmic charts, the decline of 20% all the way back to the decline that we saw at the beginning of the dot-com bubble. We saw the dot-com bubble ended up having another 60% to go. Think about it. Dot-com bubble, tech indices down, that is the NASDAQ, down 80%. We're down just 20% now on the NASDAQ. So who's to say there isn't more pain ahead? I mean, after all, we fell 20% in 2018 simply because the Federal Reserve was raising rates. And it took them U-turning on raising rates to flip the script. We've got a few more levels of uncertainty at this point. So how could now potentially be a bottom? Or is it potentially a bottom? Well, to try to evaluate whether or not we're near a bottom, I think it's very helpful to look at the levels of fear in the economy and our geopolitical environment, and then try to determine, is it possible for fear to get worse from here, or can fear get better from here? And this is something for each of us to evaluate. So let's take a look at this. Keep in mind, every day when I start thinking about these sorts of thoughts, I always have conversations with you in my course member live streams, give you insight into exactly what my thoughts are in terms of what I'm doing with my portfolio. Take a look at those programs linked down below. There's a coupon code expiring on the 25th, which is only a few days away. Take a look at that. But for now, let's get started with this. Take a look at this. So in 2021, these were roughly the fears that we had. Higher inflation for longer and the Fed rate liftoff. This is where we feared that, oh my gosh, we're going to get 2018. And if we get 2018, markets could fall 20%. Oh no. Okay, well, now we're down 20%. But we have way more than just these fears. Take a look at the list of fears that we have right now. Oil, somewhere between $100 to $120 per barrel. Yeah, it's down today. Great, $105, $106, $108 per barrel. Doesn't really matter. But the spike in energy costs from the 90s and the low or the high 80s where we had been is going to lead to inflationary panic, right? This is suggesting that inflation might end up hitting 8, 9, maybe even 10% next month when we look back to March and see what inflation was actually like in March. And we know these numbers are way underestimated anyway. Now the market's also pricing in some degree of nuclear conflict or conflict with NATO. Now, I think this is probably less than 10% because I think the odds of this are quite low, but the market will price some degree of this sort of fear in. The market always likes to price in as much as it can. And just because something like, well, I guess the way to say this is things aren't binary, right? It's not like, okay, nuclear war is going to happen. Okay, today it's not. And then the market just flip-flops back and forth. It's much more like a gradient. And so as percentages change, we see markets move, right? This is why when we go from maybe a 20% chance of a recession to a 40% chance of a recession, we're likely to see some red in the market. And that's approximately, I'd say, where we sit somewhere now. Still less likely that we're actually going to have a recession than it is likely that we'll have a recession. Now, I know this is a little bit of a change from my POV. I previously had these flipped, but that's because I believed that the Federal Reserve was going to rug pull us this summer. But they've already telegraphed that they would not rug pull us. In fact, not only are they telegraphing to us that they're not planning on rug pulling us, but they're telegraphing to us the memory of, first of all, FATE, flexible average inflation targeting. And what did Jerome Powell just tell us? He just told us that, hey, you know, our current target of inflation is 2%, which means if inflation is, let's just say as an extreme, 0% for a while, like, I don't know, 5 years, and 10% for 1 year, maybe it'll average out to 2%, right? Just as an example, okay? I didn't do the perfect math on that. But what's more important here is what Jay Powell just said. And he said, hey, you know, remember, we still have flexible average inflation targeting. And while he was in Congress just a couple weeks ago, what did he tell us? He told us we might end up having to move our inflation target up. That might imply 3% or 2.5% or maybe 3.5%, right? And that is a way of telegraphing, hey, we're not planning on rug pulling the market. We're going to go slow with our 25 basis point rate hikes, but we're going to do them consistently. I think the market right now is pricing in about 25 basis point hikes. I think up to 17 realistically are possible. That would bring us to about 4.25%. I wouldn't be surprised to see that, though, if the Fed U-turns at any point between, let's say, hike 5 and hike 17, that would be quite bullish for the market. Market right now appears to be pricing in some global GDP decline. Then, of course, wow, this is kind of embarrassing, but the Apple device here auto-corrected Shenzhen, China to that. But anyway, we've got these new COVID lockdowns in parts of China, especially the tech hub within China, Shenzhen, and these are creating substantial supply chain fears. Again, that's just news over the last 24 hours, so could be one of the reasons we saw pain in the market today. Of course, Elon Musk on Twitter, he didn't respond directly to me, but he asked, what did everybody think about inflation? And I'm not trying to pat myself on the back at all, but I replied with my inflation expectations, which you can follow me on Twitter if you don't yet, at RealMeatKevin. But anyway, in addition to replying with sort of my expectations for inflation, I also replied and said, hey, can we get your opinion too? That is, do you see any improvement in supply chains? And Elon Musk replied to himself that more broadly, things actually seemed like they were getting worse at Tesla and SpaceX, not better. This is all before he challenged Putin to a fight, but that's a different thing. We've now seen the 10-year Treasury yield spike. It's actually, just about a week and a half ago, it was 1.7%. Our previous peak was about 2%. I shorted treasuries at about 1.89%, and basically the higher these go, the more money my short makes. And now they've gone up to 2.14. They've hit a record. So at least my short's doing well on treasuries. Some of my longs didn't like today, but that's okay. I bought a little bit today, but I'll talk to you about why. So 2.1%, we're actually at 2.14% now here after hours on the 10-year. And then, of course, this fear about consumer spend and consumer sentiment declining, right? So all of these things are really built into the fear perspective that we have right now. And it's so wild because if we compare this to 2021, there was very little reason to be fearful. In fact, if you go back to the fear of, let's just say 2020 here, for example, what was the fear that we had in 2020? Well, the second wave, right? You remember that? The second wave fear or the election drama? Why did we buy the dip like crazy during these times? Well, we did because the Fed was our friend. This was very clear. The Fed was our friend, so it was easy to buy the dip then. Now, the Fed has essentially no longer become our friend. They kind of stopped being our friend somewhere in 2021. And that's when we started getting a little bit more fearful about higher inflation for longer and the Fed rate liftoff. But now we have all this. There is a lot of fear priced into the market right now. And so now there are questions over, is it possible that this could be a bottom? Is it possible that now's the time to buy the dip? And there are a few things to look at. First of all, I want to look at one quick technical here, or we'll look at a couple technicals, and then I want to tell you a little bit more about my thesis. So, keep Kevin up right here. So first of all, take a look at this. You got a triple bottom here on the QQQ on the 0% Fibonacci line. Now, if you saw my video last week, you know that I've moved the Fibonacci down from where it was at about 320 to about 318.5. And I moved that down when we hit this bottom right here on about 3.8, when we had about the start of our double bottom. So I did slide the fib down just slightly here, just to update that accuracy. And I always like to give you updates when I move the lines, otherwise I don't move them. We did fall slightly below that, but that's okay. You can oftentimes extend below the fibs, just like over here. But we did close above that fib. We closed at about 321 is where we're trading for right now in after hours, but closed approximately right at the fib. And so what's incredible about this is we have now tested this 0% Fibonacci on the NASDAQ 3 times. Okay, good. We haven't really seen triple dips on the NASDAQ here at the same level of these sorts of extremes. And in my opinion, these sort of longer candle wicks are a little bit of a sign of potentially large margin calls happening in the industry. That is, people are waking up this morning to margin calls, they're getting liquidated, and they're forced to sell. This is why you do not want to be in margin in this environment, right? And we're going to talk about my expectations as well here, but quickly, look at the QQ, or the SPY here. The SPY here closed at 417, which is just fractionally below my 420 0% fib. And look at that. You're almost triple bottoming here as well. I think if my fib was about 20 cents lower here, actually probably a little bit more like 60, 70% cents lower, then we'd be right under these candles right here, minus the wicks, which I think these wicks are really margin liquidations here. But you're seeing a very similar triple kind of bottom here. I personally think when we compare these two sets of triple bottoms, the SPY and the QQQ, to this level of peak fear we have, there's this potential that, is the market maybe done pricing in fear? That is, have we fully priced in all of this fear? And see, this is where a lot of folks say, no way, how could we price in all of the fear, Kevin, when we have the Fed meeting on March 16th. It's actually on the 15th is when it starts tomorrow. It just ends on the 16th. But so we generally say the 16th because that's when we hear about it. And in my opinion, and I said this in January, I think it's very convenient for people to forget this because they just like to read titles. Like there was somebody who had a really good tweet on Twitter. They said, you may want to go watch Kevin's videos instead of just reading the titles. No different than a Karen on Twitter. You're trained by the headlines. Shout out to Babbage. Thanks. I nailed it. But see, when I sold in January, I made it very clear that I believed we would hit a level of peak fear before the Federal Reserve meeting of March 16th. And that I wanted to buy back in before March 16th because I believed that this is when we would get peak fear. And so this is where I try to challenge myself because I could also be wrong, right? And I try to ask myself, how can we get more bad news? We can, because we can't look for black swans because you can't see them, right? We have no idea what a black swan could be. There could easily be another black swan. I mean, look at it this way. In 2021, were we anticipating war with Russia? Were we anticipating an oil price shock to 130? Were we anticipating some of the madness that we have now? No, of course not. Were we expecting that we were going to get Omicron that was going to mostly remove COVID from our society, with the exception of in China, where we have a lot of supply chains and reliance on supply chains? No, of course not, right? So there's absolutely the likelihood that there are a lot of bad news things that just are not priced in yet because we're not aware of them yet. That's fine. That's possible. But if we look at these items here, I'm not sure that these items by themselves can get substantially worse. In fact, I believe that these items are likely to get better before they get worse. For example, I do not believe that the Federal Reserve is going to rug pull us. And they're going to make that crystal clear on this March 16th meeting. Watch my video yesterday when I broke down, I think it's called Watch Before Wednesday Urgent or whatever. Very important video about the summary of economic projections. That is going to be a critical catalyst for this market. You really want to understand that video. Because when that summary of economic projections comes out, you might want to sit there ready to trade, depending on what you want to do with your portfolio. But we've already started seeing oil come down, right? Not only have we already started seeing oil come down from some of the peaks, but look, when OPEC and Occidental, whatever, when these massive oil companies tell you we're not going to drill more oil because we think these high prices are transitory, they don't use the word transitory, but they literally tell us, like, we're going to take this extra money from selling oil at higher prices and we're going to pay down debt and we're going to raise cash and then we'll have more cash during the down cycles. When the CEOs are telling you that's a sign that they know these oil prices are going to go down. They will go down. And I've been expecting a commodities collapse. That does not mean we are at peak commodity prices. Don't get me wrong. Commodity prices could still go up, but I've been calling for a commodities collapse. And you're starting to see some of that. I mean, even just look at the wheat ETF, WEAT, right? You're starting to see that pain, that momentum that carried us up over here is starting to go away. That's because fear is starting to wane. I know that sounds insane because this is what it feels like when you're at peak fear. Like, there's so much freaking fear right now. How could somebody tell you we're potentially at peak fear? It sounds idiotic, right? Maybe it is. But that's why I'm trying to logic this out. Like, I don't have a crystal ball, but I do try my best, not only to be as transparent as possible, Not only on this channel, I mean, I think I telegraph all my intentions so freaking clear. But you know, when I do all my buys and sells, I'm the only person who tells you what I'm doing with all my freaking portfolio. Of course, every single move in the Stocks and Psychology of Money group, linked down below. But still, that's nerve-wracking. I hate the judgment because I'm just trying to do my best though, right? Anyway, so inflation of 8, 9, maybe 10% for March is priced in. And Jerome Powell already told us that we're expecting a one-time shock from energy and food prices. Again, look at what we're already seeing with food prices on wheat, right? I know we've had like a nickel short squeeze and some madness and things like that. That's okay. That's going to happen. Those sorts of wild things are going to happen. But anyway, I would say this really gives us upside. It's almost kind of like inflation's so bad that Russia and Putin are like, let's just make it really bad, and then it can only go down from there. And I bet you that is what the Fed is betting on. Personally, I think a 10% fear of nuclear or NATO conflict is highly overblown. So I think that's an upside as well. In fact, if you jump over here to the Ukraine scenarios, I did a video on this weekend. I hope you watched it. I think there are 5 scenarios. Gosh, man, with it's a Siri here. Coupon instead of coup. Anyway, with the Ukraine scenarios, I think there are 5 scenarios. A Russia win, and then you have a long-term insurgency in Ukraine, which would be disastrous. Longer-term sanctions. This would be bad. Not good. A partial Russian win and Zelensky BK, also not ideal for markets. A negotiated end. Crimea, Georgia ended within 6 to 14 weeks. We're only 3 weeks into this. I think this is absolutely a huge upside potential. I don't really think a coup d'etat is likely, although Putin getting toppled either by the people or the military is possible. And in my opinion, the only reason Putin would get toppled is if the military and generals and the people or decided Putin's lost his mind and they kick him out and they send him to an island like Napoleon Bonaparte, to go live in obscurity and solitude. So I personally think this would be an upside. And then I really don't think that this NATO war is very likely. I don't think that at all. I think there's a lot of saber rattling. And there's a reason Russia's shooting RPGs at the office building of a nuclear reactor. It's to increase their negotiating posture. That you want to create nuclear fear. How about you go over to 6 reactors in Ukraine that are responsible for 15+% of the energy output of Ukraine and just start blasting away. That's going to create some fears. So it's terrible. But anyway, I do think that a negotiated end is highly likely. We've seen softness from Putin on this. We've seen softness from Zelensky on this. Okay, so that in my opinion means we have upside again on the Ukrainian conflict, which really, I suppose could be another line item in here. So I'm just going to put Ukraine in general, because you have the upside on nuclear fears, but then you also have just upside on Ukraine in general. There are other downsides. I don't think we're going to see this rug pull. This 725 basis point hikes or whatever, no problem. The markets did fine when we had this between 2004 and 2006, which that is literally what Jerome Powell said we should compare to. So he thinks we're more like a 2003 and 4 than like a 2007, right? That's his comparison, okay? His words. The rate hikes of the early look, when I listen to Jerome Powell, I listen to every word. People think I'm crazy, but there's a reason he ends up in my dreams at night. Most of the time, nightmares. Okay, this sounds wrong. Anyway, the recession fears. Okay, so this is TBD, right? The recession fears could be a problem here because they're going to give some resistance to higher prices. What recession fears are going to do is they're going to prevent us from hitting all-time highs. You're not going back to all-time highs. Probably not this year, honestly. We're not going back to all-time highs. So if you're buying call options thinking we're going to go right back to all-time highs, I don't think we're going back to all-time highs anytime soon. Could be wrong. Don't think so. The global GDP decline will also keep this sort of limitation here. The Shenzhen lockdowns and the inflation, I think there's really only upside from this because Omicron will fade. When the Chinese get sick, everybody's gotten sick with Omicron. Let's move on. Now, I know there's some renewed fears about Deltacron. We've heard these fears before. We'll wait and see. We'll see. Sure, that's just another potential, black swan. But it's not something I'm worried about right now. But then again, things could change. So we'll keep an eye on that. Okay. So we'll put a little asterisk down here, and we'll put Delta C. Okay, Cron. I'll just write it now. Okay, then same thing. I think upside for Elon, the logistic issues, the treasuries. Okay, this is a problem for the real estate market. It does not have to be a further problem for the stock market. I really would not be surprised to see the 10-year go all the way up to 3%. That's just my expectation. And it's not going to be great for real estate in the short term. It's going to create some headwinds. So we'll watch this. And then same thing with consumer sentiment. This is sort of a sideways risk. But I think once some of these other issues go away, it's likely actually that consumer sentiment would rebound. So I'm actually going to say that has upside. Okay, so in my opinion, everything here is either like max fear priced in or has upside. Unless, of course, there's some other, black swans, right? So the big thing that's stopping people, in my opinion, from buying today are twofolded. One, margin calls, because they haven't been watching me since November, telling people to get out of margin. Literally since November, I've been saying, close your call options, get out of margin. Or limit your margin, because I did go briefly into margin for a short period of time myself. Stupid. Don't do that. I never got margin called. Okay, 2. Margin calls are going to be a big issue. Number 2, Fed fear. Seriously. People who do not pay close attention to Jay Powell think he's going to come out with another big rug pull. Maybe he will. I don't think so. We just heard him 2 weeks ago in Congress lay out his plan. The summary of economic projections is going to be interesting because that's not just Jay Powell. That's everybody together, right? But we'll see. So in my opinion, if you're investing in this market or not, and you're sort of on the side waiting, wondering what to do, in my opinion, if you are going to sell, if you're looking for a sell opportunity, my expectation is the time to sell is probably somewhere between March 16 to March 25, 27, something like that, right? Before we get back into labor and CPI and fears like that. Maybe even the 25th, that way you're a week before labor on April 1st, and then CPI on April 12th. I think this is potentially, St. Paddy's Day kind of excitement time. But that also potentially makes the time to buy today, March 14 to 16 at 11 a.m. My thesis could be very wrong. So we just wanted to provide you updates on this. One thing I would say in terms of which stocks that you choose, I would really lean probably towards companies that have the best capacity for handling supply chain issues. In my opinion, those are your bigs. All right. Just a quick example. There's some other names that I have. Maybe we'll talk about them in the course in the morning. Probably will, but just as an example. You can kind of think about this yourself. All right, so my thoughts. Check out the programs linked down below on Building Wealth. I appreciate you watching this. A little bit of a longer video, but I think lots of good information. My goal is to bring you as much value per minute as possible. Hopefully you agree with that, and we'll see you in the next one. Goodbye.